Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is March the 6th. I've been back in my office for just a couple of days, and much like probably most of you, I've been watching the market being very volatile. Yesterday we were up a little, and today we crashed again. So, bouncing up and down like a yo-yo. And of course, this makes people feel very insecure, and it's certainly not nice as an investor to see your stocks entering correction territory, as we have seen pretty much with energy over the last couple of days or so, or the last couple of weeks. So what I thought to do is revisit some of my energy stocks that I talked about before, which now dates back to January. So it's already 6 weeks out of date. But what I want to do is take a little bit of time to just revisit some of the stocks that I not only own but also added during the past couple of weeks or so. So we're going to talk a little bit about those energy stocks. And then what I want to do at the end of this video is I want to give you a few stocks that you can add to your watch list. And some of them are looking pretty good. They are going to be different stocks for different people for different reasons, because some of them are small caps or micro caps and the others are dividend stocks. But let's get into the discussion here. And first, I want to talk about the sort of proverbial elephant in the room, and that is the market sort of entering correction territory, certainly from a NASDAQ point of view. If you look at the S&P 500, all the sort of post-election gains and euphoria about Trump winning the election and the commensurate Trump bump that many people spoke about, including myself, seems to have dissipated. It's gone away. And right now, we're kind of back to where we started a few months ago. Certainly from an energy point of view, we are actually sort of, we've fallen behind in terms of where we were just 6 weeks ago. But what I want to do here is just once again revisit history a little bit. So on this chart of the spider ETF. So this is SPY, and by the way, I own SPY. But if we look at SPY since its origins or its beginning, there have been a couple of incidences, and the more you stretch the timeline, the more you actually flatten these enormous peaks and valleys that the market experiences. So if you had only looked at the period there where the first red circle is, it literally would have looked like this, because what happened is on Black Monday, October 19th, 1987, the Dow lost 22% in one day. And we haven't experienced that, but what we have experienced is, 2%, 3%, 5% in one day on a number of consecutive days. So over a period of time, it kind of looks the same. If we look at the period around the year 2000, the bursting of the dot-com stock bubble caused the market panic. There were massive sell-offs, and by 2002, investor losses were estimated at around $5 trillion. That was around the same time you could buy Amazon for about $2, right? So after the crash. And then we have this another red circle that I added here, which was the period sort of around 2008, between 2007 and 2009. US households lost over 16 trillion, right? So now we more than 3 times the dot-com bubble, 16 trillion. The value of the stock market fell by about 50% over a period of time, once again, right? So it's not in one single day like we saw on Black Monday in 1987, but it's rather over a period of time. The market fell by about 50%. So now the question is, and obviously I appreciate the fact that many of the people who might be watching this are significantly younger than what I am and some of our other viewers. And, when I talk about the financial crisis of 2008, 2009, I have to sort of keep in mind that this is now, getting close to 20 years ago. And what did you do? So if you were in the market at that time, which many of us were, if you did nothing, and this is what I'm showing you here, even including the pandemic crash that had the market lose about 35% of its value. If you had done nothing since inception, you would have been up 1,216% over that period of time, right? So quite literally, if you had opened a position in SPY when the ETF originated and you could buy it for 20, $30, and now it's trading at like, let's call it $600, you'd be up 1,200% over that period of time. So what I'm getting at here is when it feels like everything's falling apart and you look at your portfolio every day, which is a scary thing to do, right? But I guess maybe we all do that for sure. I do that. You see everything going down and you think like, this is just horrible. The sky is falling and we're all going to wear blue caps, right? This is kind of what it looks like. And let's look at the energy stocks. More specifically, right? So if I look at five stocks here, and these are five of my largest positions in terms of energy. Fortunately for me, four of them start with an E. So even if I had to list them alphabetically, they'll just be E, 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 and then Phillips. But what I want to do here is just take a look at them over a period of time. And the first slide is 5 days. So over the past 5 days, I've lost about 5% with the exception of Enbridge down at the bottom, which is the odd one out, but Enbridge is the odd one out virtually on every slide. So stick with me here, right? So you can see these pretty little lines, the colors here match the lines on the graph. So the outperformer here was Enbridge over a 5 day period. Ironically, of the five stocks that I'm showing you here right now, Enbridge is the odd one out, not only for the fact that it was actually green while the others were red, but it's also because it was Canadian and the other four are US domiciled stocks or issuers. Year to date, though, the picture looks a little bit different, right? So we know, for instance, if you've been with me for a while, that I actually only opened my positions in Phillips 66 and Exxon Mobil in January, right? So my year to date is very valid year or very apt because I can kind of add these two together and say, well, collectively, I'm up about 5% or so. And then if we look at the Energy Select ETF, this is XLE. It's green, but look at Energy Transfer, one of my favorite stocks and one of my largest positions year to date. And remember, it's only March, so we've only 2 months into the year. It's down 8%, right? Do keep in mind, though, that these gains and losses that I'm showing you here exclude the potential for reinvested dividend or even the dividend payout in cash. So I'm not taking that into consideration because if I did, I could say Energy Transfer is down 8%, but on an annualized basis, it pays a dividend of over 7%. So that's almost like a wash, right? But not too much movement here, except a little bit of an uptick on Phillips, which was a beaten down stock, which is one of the reasons why I bought it. How about if we go back a little further? So 1 year period, Phillips was the one that got crushed, right? So fortunately for me, I didn't buy into Phillips a year ago when it was down 20%. I only bought it in January, so it's kind of okay. And at that time, I was doing a little bit of homework and I shared with you two of the stocks that would be worth buying or adding to if you had an existing position was Exxon Mobil and Phillips 66. The others that are on this list here, so Energy Transfer, ET, XLE, the ETF, and Enbridge, I've had as foundational stocks in my portfolio for a much, much longer time than that. But over a 1 year period, Energy Transfer is still up 20% and Enbridge 20%, right? So Enbridge, once again, an outlier, not only for performance, but also for jurisdiction because it's a Canadian stock. But once again, as I did at the start with SPY, let's flatten the curve and look over a 5 year period. And this is an interesting graph to look at, right? So the underperformers here, Energy Transfer and Phillips 66, very, very much depends on what your cost basis is or when you actually got into the stock, right? So I started my position in Energy Transfer around about 5 years ago and then built the position um, basically riding this nice little dip here, right? So I have a cost basis of about $8. So when it's trading at $18, it's still doing quite nicely. And I reinvest all my dividends. So my 76% there is well over 100. The XLE ETF over a 5 year period is 100%. And that's interesting math, right? Because if you can grow by 100% over 5 years, that means you double your position over 5 years. That means you grew compounded at 15% per year, which is pretty good because you are probably at the very least performing in line with the market or even outperforming the market. Phillips 66 got beaten down. I bought it in January, so my cost basis is actually a little lower than that. Exxon, it was a new position for me. So I didn't own it 5 years ago, so I didn't get this 122% gain. But you may recall, if you've been following the channel during that time, I was long in Occidental and my cost basis was about $10. My average exit position was about $65. So I got a 6X on Occidental Petroleum. I no longer own it. And Exxon, unlike Occidental Petroleum, is not a cheap buy for me to make money. It's a foundational stock. I'll just keep it and reinvest the dividends. So in terms of what you're looking at here, these are not stocks that I necessarily buy and sell. None of them are necessarily going to make you wealthy, because if they pop, they're going to pop about 100% over 5 years. And that's really what I want to show you. So if you flatten the curve in terms of the graph and you look at it over a 5-year period and you can get to around 100%, you've grown a compound of 15% per year, which means you double your investment portfolio every 5 years. So let's look at them individually quickly. So I did mention you're not going to get rich buying Enbridge. This is from TipRanks. The analysts expect the average price to be about 46.87, which is not much higher than where it is currently trading at around $42. There are 4 analysts saying a buy, 6 are saying a hold. It's a moderate buy. The highest price target is $60. That's probably a little bit over optimistic. And the lowest price target is 41.92, which is sort of in line with where we are right now. So in terms of where Enbridge is trading right now, you got about a 10% uptick and you have about a 7% dividend. So not a bad foundational stock to hold in your portfolio, but it's not going to make you rich because it's not going to give you 5 or 10x. Right. So Enbridge currently, as I said, trading around $42. That's your purchase price if you want to buy it. Over the past 1 year period, I'm up about 20% on this particular stock, but down here at the bottom, you can see its forward dividend yield currently based on the current stock price is about 6%. And remember, the dividend yield is expressed as a percentage based on the fact that it pays out $2.61 on a $42 stock. And that's where the 6% comes from. The PE ratio is a little bit rich right now, so it's not really a good time to open a position in Enbridge. If you want to hold it long, like I do, you may want to have it pull back a little bit. If it drops below 40, it would certainly be a nice buy and a little bit more of an attractive PE ratio as well to open a new position if you don't have a position in Enbridge. Let me just go back there for a second. I just want to talk a little bit about Enbridge quickly because many people are not too familiar with it. So Enbridge is for me similar to Energy Transfer, but it's a very diversified company because it owns pipelines in Canada. It's petroleum and it's gas in the province of Ontario, which is the most populous province in Ontario. Enbridge is also the utility that supplies the gas for heating and cooling. So the diversification there is good. And effectively, if you think about it, if the majority of people who live in Canada, so in Ontario, 10 million plus people, send Enbridge a check every month for heating and cooling, and they need both for about 6, 7 months of the year. It's too cold not to heat your home, and for a couple of months every year, in July and August, it's too hot not to cool your home. So every time, for at least 10 months of the year, you're probably sending Enbridge a nice fat check every single month, and for the other 2 months, you don't have to pay them too much because the weather is much more moderate and kind to you. But anyway, that's Enbridge. Let's talk a little bit about the next stock here, which is Energy Transfer. And I mentioned already this is one of my favorites. In fact, right now in my energy portfolio, it is the largest one by far. It's a strong buy right now. It's got 9 analysts saying buy and 1 saying hold, and nobody says sell it. The lowest price target is $20 now. We're actually trading below that right now, but the highest price target is 25. This is sort of a combination of a good dividend paying stock and a nice bit of upside that potentially is yours. 2288 as an average is fair. It's realistic. If you ask me in my most optimistic mood, I'd say it's a $28 stock. And in my most pessimistic mood, I'd say it's an $18 stock. So I wouldn't average that out. I think this is a reasonable average, 2288. And then, of course, if you have the ability to do so, you can also enroll in a DRIP, which is a dividend reinvestment program, and just reinvest the dividends and keep it and grow your position. Over the past 1 year, despite the recent drop, it's still up 18%. The PE, unlike Enbridge, is very reasonable at 14, and the forward dividend yield currently is just over 7%, which is very generous. And they've been increasing the dividend every quarter, just fractionally. So it's trending up, not down. That's good as well. Of course, during the 2020 pandemic, they cut the dividend, but then reinstated it shortly thereafter. So this is a good dividend yielding stock. It's got some nice upside here. Trading at around $18 or so, I think we could see Energy Transfer closer to sort of $21, $22 within the next 5, 6 months or so. That's my take on this one. How about Exxon? So a moderate buy, 14 analysts are saying buy, six are saying hold. It's got an average price 133. I think that's reasonable too. If it gets there, I'd be happy at 25% upside plus the dividend, which I can reinvest again. So once again, this is tip ranks. So it's giving you a sort of a snapshot from the 20 Wall Street analysts that are covering Exxon. And this is its chart, right? So this one looks a little bit worse in terms of the 1 year performance. It's down just a smidge. 1%. Now, of course, once again, you can say it has a forward dividend yield of almost 4%. So if you held it long over 1 year, you're actually up just 3%, which is probably okay, given the fact that the market has been so incredibly volatile. The PE ratio on a trailing 12-month basis, TTM, is trailing 12 months, is reasonable, 1348. This is a good buy as a foundational stock. Once again, not going to make you rich, but it's the kind of stock you could just tuck away in your portfolio and keep it sort of almost forever. Phillips 66. Now, if you had bought Phillips 66 when it was crushed, that would have been a really, really good time to get in. But of course, time in the market is much better than trying to time the market. But right now, you can see Phillips 66 is rated moderate buy, 8 buys, 5 holds from the 13 Wall Street analysts that are covering it. They have an average price target of $135. The highest price target, 162. I don't see us getting there anytime soon, especially considering that President Trump is basically on a mission of saying drill, baby, drill, thereby increasing supply. So if you've got OPEC increasing supply and you've got the United States increasing supply, if there's not commensurate demand, then all you're doing is creating an oversupply. And if there's too much available, it's going to put negative pressure on the price. We did see during the previous term that President Trump served, so 2016 to 2020, energy stocks were actually poor performers. So as much as he is focused on saying drill, baby, drill, he's also focused on making sure prices are low for his constituents. That also means the price of gas at the pump, which effectively directly impacts the price of everything else that you purchase. So as long as there's downward pressure on the price, it's highly unlikely we're going to see a huge uptick here. So this $162 is, in my humble opinion, hopelessly over optimistic, but the average at around 135 is actually fairly reasonable. We have a PE ratio here that is too high right now, 24. If you want to open a new position, maybe wait for a little bit of a pullback. Over 1 year, it has pulled back 18%. So it's actually sort of corrected. So I think, if you could buy it for like less than $120, you're probably okay. I don't know if I want to open a new position right here, right now. Of course, I have an existing position. If it pulls back below 120, I might be inclined to add a little bit more. But we'll see at that point in time because there's so much that you can buy and there's so many good deals available right now. So this doesn't look very, very tempting to me, other than for the fact that I already have a long position in my account. Nice dividend, $4.60 on an annualized basis is yielding almost 4%. So that's pretty good, So if I could realize this sort of 12% upside that the analysts predict, and at the same time reinvest the dividend around 4% or so, it's okay. That's the 15% that I'm looking for in order to achieve on an annualized basis, because it allows me to double my portfolio every 5 years. If you're young, you can do that many times because you have many multiples of 5 years ahead of you. For old guys like me, I can maybe do this another 2 or 3 times, and then I should probably just go and sit on my deck chair and drink ice cold beer on the Florida beach. How about this one, XLE? XLE you can almost buy anytime you want, right? So this is one of those buy and hold equities, or that you can just keep in your account. If you want, you can keep it in your account forever. What I do is I put spare cash into XLE, and then when I get a good buy, or I think there's a sweet deal available, like Phillips 66 at a low price, I'll move some money out of XLE into Phillips 66. And conversely, when I take profit, like on Occidental Petroleum, I'll put some money back into XLE again and just sit on it for a while. It's a great ETF, this one. Firstly, it's energy, which means it's something we use every single day. And even when it's under downward pressure, as it is right now, it's still okay. And it's perfectly fine. It's quite okay. This is not a bad deal, $85. for this ETF. By the way, it's about 20% Exxon, 20% Chevron. That's 40%, and the other 60 of the top 10, 60% or so is all blue chip, wonderful companies that are US energy companies, and all of them are great. The analyst is basically saying 8 of them say outperform here, moderate buy with a average target price of $107, 26% upside. You know what? I'd be okay if it just gets back up to $100. So I'm not greedy. 107 would be nice, but hey, you know what? $100 would be quite okay. When to buy it? As I said a minute ago, trying to time the market is difficult. Time in the market is much better. $85 is a sweet deal on XLE. You could probably just buy it right now, right here. So there is the current price. Over the past 1 year, it's down 2%. Once again, if I use the dividend yield on this one, I don't have it on the screen here, but it's currently yielding about 3.5%. So if you're down 2.5 or 2% and you're yielding 3.5 on the dividend, and you can reinvest the dividend, then you're actually up positive about 1%, which is not a bad place to be in a market like this. There's the indication if you look at it from a PE point of view, so price earnings ratio point of view over the trailing 12 months is below 15. It's a decent buy at $85. Can it pull back some more? You bet, right? Can it go up from here? You bet. Which way is it going to go? Nobody knows, right? It doesn't really matter. This is one of those that you can just buy and you can hold it quite literally if you want to, and you're young, you can just hold it forever. The expense ratio is another thing I'm highlighting here because it's an ETF. It's a fund, so you have to pay the fund manager, but your expense ratio is only 0.08%. So it's pretty good. How about the news, right? So the news distracts us very easily. So I just highlighted a couple of them here, right? So is OPEC supply boost pushing oil to a breaking point? Who knows, right? Uh, so OPEC is boosting their supply. President Trump says, "Drill, baby, drill." President Trump's mission right now is to impose tariffs on surrounding and neighboring countries like Canada and Mexico. Of course, Canada is not only an importer but also an exporter of energy to and from the United States. So, I mean, these things have direct impact. What he has done, though, is he said that the energy tariffs on Canada will be only 10%, whilst the rest of the tariffs will be 25%. You know what? There's always going to be this kind of volatility. Don't stress about it too much. You'll be okay in the long run, right? So on Phillips 66, the noise is mainly about the proxy war between Elliott and Phillips 66 existing board. So you know, all this kind of news is just noise in the marketplace. You can, for the most part, you can just ignore this, but at the same time, sometimes it's fun to read, right? How about this one? The Motley Fool says a no-brainer. 3 no-brainer energy stocks to buy with $500 right now. And their picks are CVX, so Chevron and Exxon. So of the two, they're the same. So I'd pick one of the two, not both, right? So I'd say I'd rather have Exxon than Chevron. For a variety of different reasons. I like Exxon also because of where it is priced right now. And EPD is Enterprise Products Partners, which is pretty much the same as Energy Transfer. So I'll agree with Courtney over here and say there are 3 no-brainer energy stocks you can buy right now, but I'll just change it slightly and I'll say Exxon, you could probably just buy and hold forever. Energy Transfer as opposed to EPD, or otherwise you can buy EPD instead. You can also probably just buy and hold forever. Right now, they're priced to buy, not priced to sell. But instead of buying CVX, maybe I'll just park some money into XLE. So I agree with Courtney that there are 3 no-brainer energy stocks to buy. I just changed them a little bit in terms of what she's saying. Why? She says factors such as slower growth in China have dampened demand while profit margins have tightened as energy prices has stabilized. Right. So Courtney's hypothesis here is slow growth in China and profit margins tightening. So she doesn't say anything about OPEC boosting supply. She doesn't say anything about tariffs. She doesn't say anything about Trump drill, baby, drill. You know, so if you add those in, there'll be 5 different things. So I agree with Courtney somewhat and disagree with her just a little. But I thought what I'll do is I'll change it up just a little bit here just to end this video. And I'll give you a few stocks you can add to your watch list. So most of you will know, if you've been following the channel, that last month at the beginning of February, I had the opportunity to attend the mining Indaba in South Africa. And just a couple of months before that, I was in Zurich for the Swiss Mining Investment Conference. So both mining stuff. I'm not really into mining per se, but I actually do like to have some mining in my portfolio. Ironically, my largest mining long position is also actually an energy position because that's Cameco, that's uranium, right? So it's uranium mining, but uranium is also obviously the feedstock for nuclear energy. But these are stocks you can certainly make a note of and at the very least add them to your watch list, right? So I'm not saying you should buy them right now. Um, Depends on your level of risk tolerance or bravery or stupidity, depending on which way you look at it. Nucor Gold is an interesting company. I've met with the CEO of Nucor Gold a couple of times now over the past few months, and their mining assets are in Ghana, in Africa. So on the west side of Africa. And what's interesting about that is I asked the CEO, um, what the exit strategy is here, because when you've been drilling and you've been exploring and you've found all these rich ore veins of gold predominantly, what's the exit strategy? And he said, no, we're going to produce. We're going to go into production. So that's sort of a positive sentiment. And then I added the second question and I said, well, what if one of the big guys comes along and wants to buy you? He says, well, then we'll cross that bridge when we get there. The other one, Luca Mining, uh, super CEO. This guy, Dan Barnold, and Dan is one of those kick-ass CEOs. He's just getting stuff done. He's on a mission just to make this a great mining company, and it's actually been one of the top performing stocks on the Toronto Stock Exchange Venture. So both of these trade on the TSX Venture Exchange. So Nucor Gold, NCAU, and Luca is LUCA. You can buy it over the counter, NCAUF and LUCMF. But take a look at them, add them to your watch list. And then for the guys who are like me, maybe you have these three buckets. So one of them is sort of my foundational dividend paying stocks. The other one is sort of more, I'd say, stocks that I would trade with. In other words, energy stocks like Occidental Petroleum, where I hold positions like Devon Energy, etc. Devon. I'll trade in and out of those positions over sort of 3 or 5 years. So my bucket of foundational stocks is like my forever stocks. So Enbridge is an example of that. The other stocks I'll trade sort of from time to time, but I don't sell much. I buy much more than what I sell. And then, of course, I have my sort of little speculative basket that I play with as well. And these small cap companies fit into the speculative basket. But in my foundational stocks, I would typically hold dividend stocks. And you got to be careful here because sometimes you have a great dividend stock and then they cut the dividend and then it's no longer that great. There's an ETF here. Some people have mentioned it before on our channel, JEPI, the JP Morgan Equity Premium Income. This is one of those unique ETFs where it offers you sort of upside when the market goes down, and it offers you upside when the market goes up. So and it's paying a yield of about 7%. So it's a pretty good ETF because ETF by definition is a fund which is broad-based, so you're getting a little bit of coverage there and protection as opposed to single stock risk. It pays a good dividend and it's probably fairly reasonable to assume that this dividend is quite safe. JP Morgan obviously is one of the world's largest banks. But the other one is really, really interesting. So Torm PLC, this is a shipping company. It currently yields 33%. I'm not sure. I'm not confident it's sustainable. The interesting thing about Torm is that they just announced results today on March the 6th, and their ex-dividend date is March 19th or 20th, depending on whether you're in Copenhagen or in New York, in terms of where the stock is traded. And they declared that dividend, which is huge. So it's currently yielding 33% on an annualized basis. So if you're in the stock before November 19th or 20th, you can expect that big payday, which will come early in April. I can't remember the date. I think it might be April the 2nd or something like that. The challenge with something like this is that if you had to buy Torm, currently it's trading at about $20 or so. if you buy it at 20 bucks, now today, I think after they announce their results, it's up like 10, 11%, right? So tomorrow it might be down 5, 6%. It's a very volatile stock. And then what happens is a lot of people climb into it um, to get in before that ex-dividend date, which, as I said, is March 19th, 20th. So it's just a few days away, a couple of weeks away. So there generally tends to be a little bit of upward pressure on these high dividend paying stocks. And to be quite honest, I mean, the dividend's almost ridiculous, right? 33%, but what a wonderful dividend if you can earn it. Um, so a lot of money comes into the stock sort of leading up to that ex-dividend date. And of course, once the uh, ex-dividend date passes, a lot of money exits and the stock just tanks again, right? So I'm not saying this is going to happen to Torm, but this is kind of a normal sequence of events in these super volatile stocks, right? So it's currently trading at 20 bucks. You might see the stock sort of edging up to, 21, $22 as you get close to the ex-dividend date. And then it's possible a whole lot of people just exit as soon as they have their ex-dividend date pass, and then they exit, sell out, whatever the price is at that point in time, get the dividend payout early in April, and then look to rinse and repeat for as long as Torm keeps paying this incredibly ridiculous dividend, which is wonderful if you're long in Torm. So those are stocks that you can add to your watch list. I'm not saying buy any of them. In fact, of the three, the safest one might be the JP Morgan one, JEPI. But safe also means low risk, low return, right? The other two little guys, the small cap mining companies, I have information on them. I'm not sure that the people following this channel necessarily are very interested in you know small cap mining companies per se, but there are a couple of these, and maybe if I have enough energy, I'll make a video on a couple of them just to compare them. But for sure, add them to your watch list if you're interested and take a look and see where it goes. Anyway, that's the wrap on this one, and hope you found some useful information in the video. Thanks for watching. And if you haven't subscribed yet, maybe consider doing that. It's fun, right? Stick with us, and we'll help to help one another build some generational wealth. Thanks for watching. Take care. Bye-bye.